Welcome back to the MHP Show podcast. I'm your host, Derek Vickers. Look, on the MHP Show, we are talking about mobile home parks, operations, anything that happens, market updates, crazy things I've been dealing with in mobile home parks for the last 6 years. And look, I am glad to be back. Everybody's like, Derek, where have you been? Where have I been? Where have you been, Derek? I've been around. I've been here. No, I've had people reach out and be like, man, dude, I love your podcast. I love the energy on the podcast. Like, I listen to it when I work out. I listen to it when I do my little walks. When are you going to start doing those again? Well, here we go. Here we go, baby. We are back. And look, we've been closing a lot of deals. We've been closing deals. We just closed another deal. And we've closed 7 deals in the last, I don't know, 6 months or something like that. Probably 5 months. No, it's less than that. Yeah, maybe 5 months. But we got a lot of stuff in the pipeline. We're growing and we're expanding Victory Capital tremendously. This year is going to be a massive year for us. Before we get started on the show, I just wanted to shout out to our VC Equity Fund 1. We are getting closer to closing that. If you're looking to allocate capital in the most recession-resistant asset class, it's a hedge against inflation. We all know that that's probably worse than they say it is, right? It's a protection of capital. And through recessions and bad economic conditions, mobile home parks tend to perform very well, and historically they have performed well regardless of economic conditions. So this isn't just like an investment that's just like, hey, you put in and you hope to make some cash flow and some equity appreciation. You'll do that, right? But you got to think about the other things, right? One, it's a hedge against inflation because that's happening, right? And you're positioning yourself to be in a great asset class, a stable asset class, affordable housing that's going to skate below massive economic uncertainty. Look, I mean, if a big war breaks out, I guess people are still going to need a place to live. But I think another thing for people that invest in these funds and stuff is when you put your money to work, you got to go create more, right? You got to go create more. You got to get creative again. You got to start working again. You got to start hustling again, right? While that money is building wealth. And so that's how you build wealth. You invest, and then you, if you're not doing deals yourself, look, you definitely need to reach out to me at Derek@victorycapital.com, or you can email invest@victorycapital.com. I'd love to schedule a meeting and show you what we're doing in Fund 1. We've got 7 deals closed in Florida and Arizona. We're working on some deals in some other areas now. We're expanding, and 2026 is going to be a big year. I'm excited for where we're going this year. I mean, I think because we didn't really buy anything for really half of 2022, 2023, and half of 2024. So it was 2 years, and then we started buying again, and so now it's picking up again. And that's what I want to talk about today. And that's what this episode is going to be about. It's going to be about current market conditions and the 3 layers of our business and, acquisitions, operations, and capital raising, and what that looks like, what my outlook is on it. But I'm happy to be back with you. I got to tell you, I love doing these podcasts. I love getting questions from people. And it's really cool to see people that actually like to listen to me run my mouth about stuff, because, sometimes I'm on here and I'm like, damn, dude, it's not easy to get on here and talk to yourself, by the way, because that's what you're doing. Like when you have a guest, it's easy. You're doing an interview, or you're getting asked questions. It's teed up. But, you start going on here and you're like, damn, I've been talking to myself for a while. Right. But, nonetheless, we're here and we just get through it. So, look, it's 2026, baby. We're almost in March. The first quarter is almost over. So what have I been seeing this year? The first thing I want to touch on is acquisitions. Acquisitions has been interesting. It's an interesting kind of ebb and flow. You know, some weeks I feel like, man, there's so many deals out there. And then the other weeks I'm like, man, there's nothing out there. Right. And so I would say that an overall consensus for me is that I think sellers are maybe getting a little bit more reasonable, and I think buyers are getting a little more optimistic on where the market is going. So I think more deals are transacting right now. You know, buyers are just getting more optimistic generally. I mean, there's still some unrealistic sellers out there. But I think, you know, underlying this asset class is that these deals are going to, you know, stay in high demand because there's just a low supply of them. There's a low supply of them, so people are going to be looking for them. And you know, I was talking to a guy the other day, and it's like, you know, some of these prices, like people that got in the business, you know, 10, 12, 15 years ago can't make sense of the prices now. And I'm just like, man, will we be saying that with some of these deals that we pass on in 5 years? Man, we should have bought that. Maybe we will, but I don't think we're going to see the appreciation like we saw in you know, obviously 2015 to 2020 and 2020 to 2025, or really 2020 to 2022, there was mass appreciation in these deals. And so I don't know if we'll see the same percentage level, but we will see appreciation. I mean, I don't think anybody thought multifamily would be 500, $500,000 a unit in like Miami, or 350 grand a unit in some markets. You know, I remember when I was underwriting multifamily in 2015, 2016, when I was stuck in my analysis paralysis phase. I was on Rod Khleif's podcast the other day, and I never thought about this because I was like, I started underwriting deals in 2015. He's like, dude, you're a thinker. You're a thinker. And I'm like, no, I'm not. No, I'm not. I'm a doer. But I was a thinker before that because I didn't look at that. I don't think of myself as a thinker anymore. But I remember when I was underwriting deals back then that I think multifamily in Orlando was maybe 150 grand or 200 grand a unit. It's gone up. And I'm sure some of the higher A class stuff is probably, you know, a little bit higher than that, but I'd say there's been a big pullback in that market here, in the last few years. But anyways, right. Will we be saying that about mobile home parks in a few years? I don't know. Maybe we will. I do think that the gain is going to be lower, but I mean, look, if there's a shortage of affordable housing, if multifamily rents continue to go up, because that's essentially what we're a product of, we sort of run with that, and as long as that's still going up, I think we'll go up. But our rents are, you know, historically under market, way under market, so there's a lot of room there to get them to get the rents to market and have that appreciation. So, you know, I don't know if we'll be saying that or not, but maybe we will, because I know there's deals that I looked at in 2020 I wish I would have bought now. But, you know, you can't do that right now. And there's stuff that I probably wish that we should have bought in 2023 when it was kind of rough, right? But you know, you got to get creative with deals these days. You got to get creative with your park-owned homes. If you want to do some infill, you got to be really skilled at that. You have to be really sound operationally to add value these days. You know, gone are the days, I think, of buying a stabilized tenant-owned home park at a reasonable cap rate, to where you can just go and do nominal rent increases every year and you can crush it, right? You know, maybe you're going to find some of those in the middle of nowhere, but I never see those in the markets that I'm in. And when I do, I'm always like, what's wrong with it? Right? Oh yeah, it's got a lagoon, or oh yeah, the wastewater treatment plant is going out and it needs to be replaced. Blah blah blah. They're getting sued from the attorney general of the state, which we ran into that issue on some deals in Arizona. But yeah, look, I think there's going to be deals out there for you to be had, right? You got to be smarter. I don't want to say you have to be more aggressive, but you can't wait. Like, you cannot wait. You cannot hesitate. If you see a deal and you're like, oh, I need to see if the bank's going to give me a loan on this deal. Well, by the time you send the LOI, I'm going to have it under contract, or somebody else is going to have it under contract, right? So you got to take action. You got to take action on this stuff. You got to send your LOI. Sometimes I skip and just send a damn contract and get the thing under contract. So you got to move fast on acquisitions, because I will say this, since 2026 started, I'm getting more calls on current deals that people want to buy, right? So I see people are doing more outflow when it comes to acquisitions. So look, I think and every time I see that, right, I'm like, man, we got to start hitting it harder, because there's other people out here hitting it as well. So I think generally the industry is getting more optimistic this year on acquisitions, and transaction volume, I think, is going to increase pretty dramatically from where it was last year. I can definitely see that going into this year. So look, if you're out there hunting deals, man, you just got to send some deals, get some LOIs out there, and get the damn thing under contract. Go one step at a time. Send your earnest money. Go through due diligence. We close about 50% of the deals that we put under contract, I would say. At least that's been the numbers for the last 6 months, and that's probably more skewed because one of them was a portfolio that had 6 parks that we backed out on. So I would say out of the deals we put under contract, really, it's probably 7 out of 9, because a lot of times we can find out some of the stuff that are deal killers up front. The only deal killers that we can't necessarily find up front are obviously the infrastructure stuff, but the other deal killers, we just won't even put it under contract, right? So that's probably more of our target. But if you look at the numbers from sheer parks, it's 7 out of 14, I believe, or 7 out of 13, because we backed out of another one in Texas, because this thing was just it was a dog, man. It was a dog. Like, this lady, oh my God, this lady we go into the park, and it's a mess. My dad is actually with me because we went to the Cowboys game. So I'm like, hey, we're going to go see this deal in Texas too while we're out there. Yes, I'm a Cowboys fan. Like, I hate to admit it, they're annoying to watch. They've been frustrating me for 30 years. 25 years, really. But anyways, we go in this park, and this lady's like, she's an owner that lives at the park. So that just sort of gives you what you need to know. She's got these 2 buses on site. Like, you walk up to her house, and maybe we can edit this in, right, to where I can flash these pictures up. But the one house that she lives in, she's got like this. To get into the house, it's like a modular. There's no steps, but she got one of those like rolling set of steps that you would see on a construction site that you would use to get up on like I don't know, like a scaffold or something. But this was used to get into her house. The most crazy thing I've ever seen in my life. And then she had an above ground pool with no water in it, but it also had another above ground pool within the bigger above ground pool with no water in it. Right. And then she's got this RV on the property, like behind her house. And she's like, hey, you guys are more than welcome to stay in the RV if you want. And my dad looks at me, and we're like, no, we're good. We're going to stay in Arlington. We already got a place. Thanks though. We appreciate it. And we went into her house, and like, she's got the couch up on cinder blocks. I don't know why. She had like, I don't know if this is mean, but oh yeah. Anyways, it was wild. It was wild. Total pack rat. She wanted us to stay the night. She had another school bus there with half of the. It was like cut in half, and she's like, "Do you guys want this stuff if you buy it?" And we're like, "No, we don't. You got to get rid of it." We ended up getting rid of it anyways, but I just had to tell that story and go off when we were talking about acquisitions, because that was a deal that we passed on, because really it was going to be our first deal in that area, and it was sort of out of the way. The price per pad was actually really good on it, but it was just going to be a heavy lift. Like, somebody needed to be there to get this damn deal where it needed to be, so we passed on that one. But moving on to the next segment here, I wanted to talk about capital raising and what I'm feeling about that. Capital raising has been an interesting it's been an interesting, I would say, year on capital raising. We've done well. We've raised more money than we ever have for our fund, but it's, I don't know. I feel like it's been a little bit harder to get people across the finish line. I think when you get your ultra high net worth investors, they're always pretty easy to get across the finish line because they're like, yeah, whatever, I'll throw in a couple $1,000,000 kind of thing. But getting down to your $100,000 investor and your $250,000 investor in that range, I feel like it's a little harder to get those people to move because there's just a lot of uncertainty in the market. I mean, shit, I think we just attacked Iran. So I'm sure the treasuries are going to go, up on Monday after they had gone down last week. But, that all that stuff just creates uncertainty in an investor's mind, I think, because you can buy a 10-year treasury and get a 4% yield on it, right? So that's a pretty safe investment. So people are, less likely to invest in, alternative assets, right? So I think it's, money is not as easy to get as it was in 2021 and 2022 from investors. It takes a little bit more work, takes a little bit more trust. But a lot of our investors that have invested with us before, they're very quick to come back in on the new deal because we've done so well on these, these deals that we've closed in the last 18 months. The fund deals are still, obviously in the turnaround phase, but the 6 that we did before that, they're all paying distributions. They're all worth probably, depending on what cap rate you're using, maybe double what we paid for them. So they're doing really well, and our investors like that. So they're quick to come in. But getting your guy from zero, not knowing you, to sending you a check is, I think hasn't been as easy. So you just have to have a full pipeline of investors, and you constantly have to have that outreach going out, and you have to be networking. You have to be asking your guys for referrals. You have to be really constantly working it to get those investors in, because that's the lifeblood of your business. That's the lifeblood of your business. We've looked at some institutional capital, some family offices. We're working currently with some family offices that are coming into our deals. Institutional, we've started going down that road and looking at that, but it's not something that I want to do currently, just because, yes, it could allow us to scale faster, but I think we can scale pretty fast with what we're doing now. So I would rather, keep the equity and, instead of getting one $50 million check, I think we can raise $50 million here in relatively short order and not have to give up the economics that we would have to give up to get that one check. And then we're essentially working for them. Like, that's not, I don't like that. Right? I don't like that. And so, it's interesting, like the capital raising thing was probably one of my most weak points when I first started in this business, because I just didn't know it. I'd never done it. It was hard for me to even think of, asking someone for $50,000, for even 20, much less $1 million. And, it's just something you get used to over time. Right. And I'm cool with it now because I know we have a great product. I know I have all my net worth in mobile home parks. Like, okay, 95%, right? Or whatever the number is, but it's a substantial amount. I believe in the asset class at Victory Capital. I think we have a great product. We have great communication with our investors. Investors can talk to me directly. Maybe it's not going to be feasible to do that at one day, but I feel like I do that. I owe that to my investors now. If they want to jump on the call with me, I'm going to figure it out, because they've put their trust in me and our company, to do right by them and create, outsized returns for them. And they've entrusted us with that. And that's their hard-earned capital that they've worked for. Some people have more than others, but 100,000 for somebody might be, way more important to them than the guy even investing $1 million that's got, 50 million liquid. Right. So, I love jumping on calls for investors. And when you're growing your business out here, you should definitely be available. Right. You should be available. I like to be available. I like to have my communication out there. I like being able to talk to people. I like calling my investors from time to time, right? And just, maybe I'm asking for referrals or just getting an idea or answering some questions. Some of them think like, well, I don't want to reach out too much. And yeah, look, I mean, of course, I don't want to talk, once a week with somebody like about the same deal, because like kind of in parks, like nothing really happens over a week that's dramatically different from the prior week. My point is just being available when you're new to raising capital is good. But overall market sentiment right now for raising capital, I think is moderate. It's not going crazy right now. It's not flowing like crazy. It is flowing more than it was, but I still think people are cautious on alternative assets right now, just because all the crazy stuff happening in the world, wars, crazy stuff happening in the media. There's always something new to talk about. There's always something, somebody's protesting something, somebody's fighting about something. It's just stupid, dude. It's just stupid. And maybe I do lean one way more than the other, but like, honestly, like both sides have really dumb, like both sides say stuff at times that don't make sense. Like, that's the reality of it. Right. But, I just still think, I still think that puts uncertainty in the investor's mind. And if you watch the mainstream media, they're definitely going to pump some uncertainty into your mind. And that's actually going to affect your business. It's definitely going to affect your business. And the economy and everything is sort of about, the more that I watch it and kind of look at it, it's like, I mean, it is about emotion. Like Jerome Powell could literally come out tomorrow and be like, hey, I'm super bearish on the like, oh, I don't like this market. Like, and then everybody flips, right? He could just say, I'm thinking about raising rates another, 2 points this year, and everybody freaks out, right? And he may not even do it, right? But that's the kind of power that has, and just people's emotions go crazy. So you got to think about that stuff, right? And sort of when you're talking to people, you got to understand what they're dealing with. And so, I think, again, we're going to have a great year this year. I think there's going to be transactions, and I think capital is going to loosen up once we get a new Fed chair in here, which would be great, right? Which would be great. I think we'll all be excited about that. So we'll see. We do have bonus depreciation back, which is great. That helps with capital raising. But, unfortunately, I see people out here pitching bonus depreciation, and I'll say this, and some people can't, most people that do, like, kind of can't even use it. Really. Some can. Some can't. So, anyways, so I digress. Let's move on to the third segment of the MHP show here. We're going to talk about operations. What's your outlook on operations? What's been going on on operations? So I would say operations is sort of the least changing, part of the business here. I was listening to Frank Roth's from the boot camp. I went to the virtual boot camp back in 2020 when they weren't doing them in person, but he came with he gives you these, it's like, I don't know, it's like 12 DVDs or something. I put them on my phone a long time ago. They're super awesome, by the way. And I think you recorded them in like 2008 or something. And I've been listening to them, and they're just hilarious for one thing. But the data and operations and things, it sort of hasn't changed. The fundamentals and the dynamics of the business and the craziness, it really hasn't changed in 18 years. If you don't have those, you should listen to them. They're hilarious, and the data is really good. But my point is, operations is sort of the same. You're trying to go in, you're trying to get rents to market, you're trying to build back for utilities, you're trying to clean up the messes in the park, you're trying to convert park-owned homes to tenant-owned, you're bringing in homes if you're doing that. And you're dealing with infrastructure issues and all the other stuff that comes with that. You're dealing with crazy tenants that want to sue you for anything that you want. You're dealing with municipalities. You're dealing with all that. None of that's changed, right? And so, like, I think in this environment, and when you're buying deals, you have to be more sound as an operator. You have to have your systems correct. You have to have your hiring correct, because that's important. Who you're hiring. You have to have all of your communication, like who's handling the communication. You got to have somebody on delinquency and home sales and things like that. Like, you have to have this stuff in order, right? And, I learned this the hard way in the beginning when we grew really fast. It was like, oh my God, we have all this stuff going on, and I didn't really build out the systems that well. Okay, got it. So, you live and you learn and you build them and you fix it and it goes. But, now we know how to do that really well. And, despite we always have operational challenges, we're still able to work through that and build the next system to be even better than the one that was, currently built. Right. Your operations are never going to be set. I mean, when you scale to different levels, you get to 500, you get to 1,000, you get to 2,000, and I haven't gotten to 4,000 yet, but I'm sure it's a little bit different. 5,000, 10,000. I'm sure it's way different than operating, 3 parks. Right. So again, operations doesn't really change, but what I have seen is that, we're in hot markets, so I don't think I've necessarily seen, our stabilized parks, like delinquency is very low. Maybe we've seen like, instead of one person that pays late, maybe we have 2, sometimes maybe 3 in a park. We have one park I'm thinking about right now that was very stable, and then we have, like 2 people now that are paying late. They're still paying, but they're paying a little late, right? So I think it's just good data to think with. You still have your knuckleheads that just decide not to pay, and you have to get them out, and you get a new and a better tenant in there. So I have seen that. I've seen that home sales, so if you compare this to 2021 when you sold a home, if you had a handyman special home, you could sell the damn thing like super fast. I mean, they would just roll off the freaking shelf. And it does take a little bit more to find that now, because I don't think people have all the COVID money to fix them up like they did before. So you have to find your contractors. That you can still find these people, but it's not as quick and easy as it was before, because a lot of people, they were like, in my opinion, they were just, hey, let's go and make our own house. And build on additions illegally without any permits. Oh, well, I didn't say that. I didn't say that. People never do that in mobile home parks. They get permits for everything. They never break your rules. What do you mean? Yeah, but that was a lot easier to do than it is now. I definitely will say that, and I will say, home sales aren't the velocity isn't like it was in 2021. But I will say one other corollary to that is that our background checks have gotten a lot more stringent. And so we just don't let anybody in if they don't have a criminal record and they don't have an eviction, which we used to do in the beginning. And I'll tell you, we did that wrong, because look, if you have a 500 credit score, you literally got to say, F it, I'm not paying anything. Like it takes an effort. I feel like it takes just as much of an effort to do that as it does to get an even higher credit score for somebody, right? So if they don't pay their bills, which is indicative, country comes out, so I can't pronounce words correctly sometimes. A 500 credit score is definitely indicative of someone not being able, well, I don't want to say not being able to pay their bills, maybe, but making other choices than actually paying their rent. Right? And so you think you're going to be different? Maybe, maybe not. But anyway, so we like to get better tenants in there, because in the long run, it's going to make it so much easier for us to operate these damn things, because they're hard enough as it is. I mean, people understand the operationally intensive aspect of this business, especially in these value add properties. It's a heavy lift. It's a heavy lift. Maybe I'll start buying storage or retail or industrial someday, and just be like, I'll be so like calloused to the operations, and I'll have such an out reality like concept of like, man, operations can be hard, and it'll be like, man, this is like super, super easy. And even on these super stabilized tenant-owned home parks, it's still pretty easy, but sometimes the well goes out, right? Oh God, we had a park the other week. Some guy was it's beyond me how some of this shit happens, right? A guy runs into a telephone pole, and if you see the positioning of the telephone pole in the park, it's like, how did he do that? Took the telephone pole down. Now we have to get the electric company out there to put a new one up, and they can't put a new one up here anymore because the trees from the neighbor's property is coming over to our property. So we have to run it across the street. Well, if we run it across the street, that's where the well is. That's where the water line. It's just like, now you're into this project because some idiot ran into your telephone pole, right? So this kind of stuff happens, even in a park that's operating and cooking along. And this isn't that expensive of a job. It's just time consuming for your team, right? So this stuff inevitably is going to happen, right? If you have a park where nothing like that happens, more power to you. More power to you. But when you have a lot of these things, inevitably you're gonna have something weird that happens at some point. So I think operationally, those are my main things that I am seeing right now, is that it's a little bit, just the home sales velocity is still good in great markets. Like, don't get me wrong, like, you're still getting velocity. But in Florida, we're not necessarily getting, 300 reaches and on an ad in 5 days like we were back in 2021. So, and maybe that's because of some Facebook throttling. Facebook is just a wild system, and how they throttle people, and they don't, for whatever they do on selling homes on Facebook. Yeah, it's crazy. It's crazy. I just, get your operations in order. Like, if you want to buy deals and maybe you have to pay a little bit more for something, now you better have your damn operations in order. We're constantly getting our house in order. If we mess up, we write up the policy that prevents that mess up again, and we get it cracking. Like, we don't mess around with that anymore. So look, operate well, man, and you're going to be able to buy some great deals, right? That's what I love about this business, because like the deals that we're buying don't rely on cap rate compression. They rely on operational efficiency. They rely on us going in and implementing the business plan. And if interest rates don't do anything but stay the same, we're still going to be fine, and the deal is going to perform really well. If rates go down, we're going to crush it. We're going to really crush it. If they go up, we're still going to be fine. I mean, we turn these deals into 10 and 12 and 13 caps. If rates go up to 8.5 or 9, we're still going to have a spread there. We're not going to crush it, but it'll be a single. Your money will still be appreciating. So look, thank you all. And I'm super glad to be back on the MHP Show podcast. Shoot me a message if there's something you want me to talk about. I'd be happy to do that. We're going to start having some guests on again, but I like doing these individual podcasts too. It's a lot of fun. Otherwise, I didn't get to a point today where I felt like I was talking to myself for too long. So please like and subscribe, and let me know what your thoughts are on the show. If you think it's great, if you think I suck, that's cool too. At least tell me why. Right. And then I'll determine if your opinion really matters or not, because some people's opinions don't matter. And look, if you want to invest in VC, if you want to invest in Fund One, just reach out to me. Just reach out to me. You can go to victorycapital.com and go to offerings and check it out. You can, reach out to me via email if you want to set up a call with me and my team. We'd love to talk to you. I can talk with you personally and, give you some, my thoughts on the strategy. Look, also, if you have a 401k or an IRA, we're doing rollovers. We have multiple investors that have self-directed, not rolled over, but self-directed from their 401k. It's a relatively easy process to do. But look, if you want to diversify your 401k, be happy to chat with you about that. We have a company that we've partnered with. And hey, man, I just leave you at this, right? I'll leave you with this before we go. Just, if you put a target there, you're like, man, I want to do that. You might have a voice in your head that says, no, I can't do that. I can't do that. That's hard. I'll never get there. You don't feel good about it. But maybe there's an underlying thing behind there that's maybe thinking that. Maybe you don't think that you can like do that. Maybe you don't think you're worthy. Maybe you don't think you're able. But you just got to change that, right? If you look deeper and you're like, man, I don't think I'm worthy to have that kind of success. Well, you just need to change the thought to, no, I am, right? No, I am, right? So be conscious of what's coming through your head, man, and change it. I know I got a little philosophical on them at the end, I guess, but whatever, dude. It's my damn show. All right, guys. Cool. I will see you later. See you all next week. Peace out.